Management accounting reports are of little help to operating managers attempting to reduce costs and improve productivity. Frequently, the reports decrease productivity because they require operating managers to spend time trying to understand and explain report variants that have little to do with the economic and technological reality of their operation. Management accounting systems do not provide timely and detailed information on process efficiencies, or they focus too narrowly on inputs such as direct labor that they relatively insignificant in today's production environment. Therefore, the system not only fails to provide relevant information to managers, but it also distracts them from noticing the key factor important for production efficiencies. The management accounting system failed to provide accurate product costs. The financial accounting system treats many cash outlay as expenses of the period in which they are made, even though these outlays will benefit future periods. Today's management accounting system provide a misleading target for managerial attention. They fail to provide the relevant set of measures that appropriately reflect the technology, product, processes, and competitive environment in which the organization operates. An organization management accounting system must provide timely and accurate information to facilitate efforts to control costs, to measure and improve productivity, and to devise improved production process. The management accounting system also need to report accurate product costs so that pricing decision, introduction of new product, abandonment of obsolete product, and responses to the appearances of rival product can be made with the best possible information on product resources demand. The organization management accounting system serves as a vital two-way communication link between seniors and subordinate managers. It is the means by which senior executives communicate to subordinate and decentralized managers the goals and objectives of the organization. In the reverse direction, the management accounting system is the channel by which information about the firm's product performance and production efficiencies to get reported to upper levels of management. An excellent management accounting system will not by itself guarantee success in today's economy. Ultimately, success depends on product and meets customers' needs on efficient production and distribution system for this product and on effective marketing effort. However, an ineffective management accounting system can undermine even the best effort in product development, process improvement, and marketing policy. With an ineffective management accounting system, the best outcome occurs when managers understand the irrelevance of their system and bypass it by developing personalized information systems. Today's designer of management accounting system can use sophisticated electronic technology to devise reporting and control systems that are more accurate, more timely, and hence more effective than those designed by their predecessor. Simplified and aggregate procedures that were adopted in early decades because more relevant and timely procedure would have been too costly or even invisible, no longer needed to tolerate. The third subtopic is the management accounting's roots. The demand for management accounting information about transactions occurring within the organization is a much more recent phenomenon. Raw material suppliers, labor paid by piecework, and customers. There were no level of management, nor were the long-term salaried employees of the organization. Transactions occur in the market and measure of success were easily obtained. And as a consequence of the Industrial Revolution and the ability to achieve gain through economies of scale, it became efficient for 19th century enterprise owners to commit significant sums of capital to their production processes. A demand arose for measures to determine the price of output from internal operations. The early management accounting measures were simple but seemed to serve well the needs of owners and managers. They focus on conversion costs and produce summary measures such as cost per hour or cost per pound produced for each process and for each worker. The major costs include labor and materials and involve some attribution of overhead costs. The goal of these systems was to identify the costs for the immediate and final products of firm and to provide a benchmark to measure efficiency of the conversion processes. By the middle of the 19th century, great advances in transportation and communication, especially the invention of railroad and telegraph, provided further opportunities for gain to large hierarchical organizations. These enterprises could now coordinate the acquisition of raw materials and the distribution of final products over much larger geographical areas and had previously been possible. But without a corresponding increase in the quantity of management accounting information, these organizations would not have been able to capture the full potential gains from increased scale of operations. In fact, effective management accounting systems were necessary to coordinate efficiently the logical, conversion and distribution activities of these enterprises and to provide summary measure of performance for decentralized and dispersed managers. Perhaps the best examples of effective management accounting system could be found in the railroad corporations of the mid-19th century. At the time, they were the largest enterprises ever created by man. To oversee their diverse and dispersed operation, new procedures were invented just to control the receipt and disbursement of cash. Improved transportation and communication combined with economies of scale also permit the growth of large distribution enterprises, particularly retail store chains. These organizations require information on the effectiveness and efficiency of their purchasing, pricing, and retailing activities. For those activities, measures such as gross margin by department, selling revenue less purchases and operating costs, and inventory stock turn were created. The management accounting measures the design to motivate and evaluate the efficiency of internal processes. There was little concern with measuring the overall profit of the enterprise. These organizations really had only one activity they had to convert raw materials into a single final product, such as cloth or steel, move passengers, or freight, or resell purchases goods. If this basic activity performed efficiently, then the organization could be confident that it will be profitable in the long run. Thus, the management accounting system was created to promote efficiency in the key operating activity of the organization. The final developments in management accounting systems occurred in the early decades of the 20th century to support the growth of multi-activity diversified corporations.
For loss relevance, based on Professor Thomas Johnson and Robert S. Kaplan, they argued that the management accounting system has loss relevance as they were inadequate for the modern accounting environment. Under the article, it states that contemporary trend in competition, technologies, and management demand made changes in the way how the organization measure and manage costs and how they evaluate the short-term and long-term performance of the organization. Management accounting practice evolved to serve the informational and control needs of the managers of increasingly complex and diverse organizations. Moreover, there was little incentive to continue to develop innovative management accounting procedures. For example, companies such as DuPont and General Motors, it proved to be the model for many corporations for the next level century. However, the diversity of products and complexity manufacturing process continues increase in the decades after 1920. Thus, the need for accurate product cost and effective process control should have imposed new demands on organization management accounting system. Yet, after 1920, the evolution still did not keep pace with the environment in corporation product and process technologies. This show that the management accounting has not changed since 1920. This eventually led to today's problem: distort product cost, delay and overly aggregate process control information, and short-term performance measures that do not reflect the increase or decrease in the organization economic position. Over the years, however, as corporation product line expand, as production technology change, as product life cycle shortened, as global competitive conditions shift, and most importantly, as great advance in information technology occur, we should have expected a reconsideration of the decision to not invest in a more relevant and more timely management accounting system. Starting in the mid-1960s, the system designers basically automated the manual system they found in the factory. Left unquestioned was whether this system were still sensible given the great expansion in information technology represented by electronic, digital computers.
For academic led astray, why did university-based researchers fail to note the growing obsolescence of organizations' management accounting system? And why did they not play a more active or stimulative role to improve the art of management accounting system design? We believe that academic were led astray focusing too narrowly on a simplified model of a firm behavior. It were influenced strongly by economists one product, one production process model of the firm. Management accounting academics found little value in the cost allocation imposed on organization by financial accounting procedure. 60 years of literature emerged advocating the separation of costs into fixed and variable components for making good product decisions and for controlling costs. The simple one-product settings used by academic economists and accountants never fully addressed the question of where fixed costs came from and how these costs needed to be covered by each of the product in the corporation. The academic researchers attempt to implement their ideas in the environment of actual organizations with hundreds or thousands of products with the complex multi-stage production processes. Thus, the academic literature concentrated on elegant and sophisticated approaches to analyzing costs for a single product, single process firm, while companies tried to manage with antiquated system in the settings that had little relationship to the simplified model. Ironically, as management accounting system become less relevant and less representative of the organization's operation and strategy, many companies become dominated by senior executives who believe they could run the firm by the number. As accounting for caravans, caravans is a group of people, especially traders or pilgrims, traveling together across a desert in Asia or North Africa. If we return to the 15th century and the publication of perhaps the original accounting book of Propacioli, who was an Italian accountant and mathematician, we can ask what kind of events were occurring that led to a demand for accounting information. As for the caravan, at the end of the expedition, the accountant subtract the cost of the caravan and the cost of the initial load of merchandise from the revenues received from the sale to compute a profit for the entire trip, a profit to be distributed among the investors in the venture. However, did the investors ask the accountant to compute the expedition's profit during the third quarter of 1487 when the caravan was traversing the Persian desert en route to India? Probably not, because even in the earlier unsophisticated days of accounting 500 years ago, investors understood that allocating the total profits of expeditions to periods as short as 3 months was not a meaningful exercise. Arguing that it is meaningless to allocate project profitability to short time periods within the life of a project does not imply that we believe it fruitless to attempt to obtain valuable indicators of short-term progress. There are many potentially useful indicators of the caravan manager's performance during the third quarter 1487, but quarterly profits is not one of them. The current competitive, which is technological environment, there are probably many better indicators of a company's short-term performance than its quarterly earning. Certainly, cash flow is important, and we would want to know that pattern and structure of a company's cash receipt and cash expenditures. But knowing sources and uses of cash is very different from working hard every month and every quarter to produce complete income statements and balance sheet replete with amortizations, capitalization, and many other accruals. Challenge and opportunity for contemporary organizations is clear. Management accounting systems can and should be designed to support the operations and the strategy of the organization. The technology exists to implement systems radically different from those being used today. The innovative spirit of 100 years ago at the outset of the scientific management movement can be recaptured by creative managers and academic researchers who are committed to developing the new concept of designing relevant management accounting systems.